Hello everyone, recently I've been studying Crocs Incorporated and I'd like to share some insights. Listed on the NASDAQ under the ticker CROX, Crocs is best known for its iconic clog, a product that has become both a cultural symbol and a consistent revenue driver. But beyond the clogs, there's more to the company's story, including its growing product range and evolving financial profile. Let's dive in. Crocs Incorporated, along with its subsidiaries, designs, develops, manufactures, and sells casual lifestyle footwear and accessories under the Crocs and HeyDude brands, both in the United States and internationally. The company's product lineup includes a wide range of footwear, such as clogs, sandals, platforms, wedges, boots, slides, flip-flops, sneakers, and slippers, along with accessories like charms, socks, bags, and interchangeable straps. Crocs distributes its products through a diversified network including wholesalers, retail stores, e-commerce platforms, third-party marketplaces, and in-store kiosks. While the company continues to grow its revenue, the pace of growth has moderated in recent periods. Crocs Incorporated's latest earnings report reveals contrasting performance trends between its core Crocs brand and its HeyDude subsidiary. The Crocs brand continues to show strong momentum, with both unit sales and average selling price on the rise, contributing to an overall revenue growth of 8.8%. In contrast, HeyDude is underperforming, with declining unit sales despite an increase in average selling price, resulting in a significant 13.2% drop in revenue. As HeyDude's downward trend persisted into the first quarter, it raises the question of how Crocs' financials would look if HeyDude's revenue were to drop to zero. Analyzing this scenario can provide insight into the core strength of the Crocs brand and its ability to sustain overall growth without reliance on HeyDude. Assuming HeyDude's revenue declines to zero, Crocs Incorporated would generate approximately $3.27 billion in revenue solely from its core Crocs brand. Applying a 15% net income margin, this results in an estimated net income or free cash flow of about $486 million, roughly half of the company's current net income or free cash flow. This provides a conservative, HeyDude-excluded baseline of Crocs' core cash-generating capability. We will use this $486 million free cash flow as the starting point for a discounted cash flow analysis to evaluate the intrinsic value of Crocs, based purely on the performance of its core brand and without the drag of HeyDude's ongoing underperformance. Using a discounted cash flow analysis, we estimate Crocs Incorporated's intrinsic value per share to be approximately $93, assuming HeyDude's revenue drops to zero and the company operates solely based on its core Crocs brand. This valuation is based on a conservative free cash flow estimate of $486 million with a projected growth rate of 6% annually for the first 5 years and 4% for the following 5 years, well below the company's historical 3-year compounded annual growth rate of roughly 11%. A terminal multiple of 10x was applied to the final year's cash flow to calculate the terminal value. This analysis provides a conservative benchmark of Crocs' standalone value, highlighting the resilience and profitability of the core brand even without contributions from HeyDude. Moving on to the price-to-multiple analysis, Crocs Incorporated currently trades at an enterprise value to sales multiple of approximately 1.9x, which corresponds to a share price of about $107. If the multiple were to contract to a low of around 1.6x EV to sales, the implied share price would decrease to roughly $90. Conversely, if the multiple expanded to a high of approximately 2.7x EV to sales, the share price could reach about $150. Let's now consider the return on capital employed, which provides insight into how effectively Crocs Incorporated is utilizing its resources to generate profits. Crocs' return on capital employed is currently around 20%, significantly higher than the estimated weighted average cost of capital of approximately 12% or below. This positive spread indicates that Crocs is creating value through its operations and that sustainable growth will further enhance shareholder value. To conclude, a prudent approach would be to buy Crocs Incorporated around an EV to sales multiple of 1.6, which corresponds to a share price of approximately $90, and consider selling near an EV to sales multiple of 2.7, or around $150. This multiple-based strategy offers a clear entry and exit framework based on historical valuation ranges. Our DCF analysis, which conservatively assumes zero contribution from HeyDude, suggests an intrinsic value of approximately $93 per share. This provides a margin of safety for investors buying around the $90 level, reinforcing downside protection even under a cautious outlook. If HeyDude stabilizes or begins to recover, it would act as a meaningful upside catalyst, enhancing revenue and earnings beyond the base case scenario. In that case, the intrinsic value could be materially higher than current estimates. With that, I've come to the end of my analysis. Thank you for watching, and I hope you found this breakdown of Crocs Incorporated insightful. If you enjoyed the content, feel free to like, share, or subscribe for more investment ideas and deep dives. See you in the next one.